Bismillahirrahmanirrahim. Today our topic is the national income. Uh, the introduction of national income. The concept of national income has great importance in economics. National income reflects the economics. In simple words, national income defines the market value of goods and services produced in economy in an accounting year. And when net factor income from abroad added into it, it is called national income. What do you mean by national income? If we add all the market value of goods and services produced in one year in an economy, and when all the income which we receive from abroad get together, it is called national income. Concept of national income can be divided into three parts. The definition of national income, there are three parts. First of all is the classic definition. Second is the Keynesian definition, and third one is the modern definition. What is classic definition? This definition was given by Marshall, Alfred Marshall, Pigou, Fisher. According to Marshall, the value of goods and services is included in national income, whereas Fisher also included income from abroad in national income. Keynesian definition: in order to calculate national income, Keynesian has used the method below. National income method. National income method is equal to y is equal to a minus u. Y denoted by national income and A denoted by aggregate sale, and U is the user cost. When we minus the user cost from the aggregate sale, then we get the national income. And what is the net national income method? Y is equal to A minus U minus V. Y mean aggregate sale, we less the user cost minus the aggregate sale, and V is the supplementary cost. And when we less the supplementary cost from the aggregate sale, then it becomes net national income method. And the third one is the modern definition. According to modern definition, national income can be calculated with the help of the following three methods. First of all is the output method. Output method, the other name of output method is the value added method, and the third name of the output method is the product method. In this method, we will calculate all the value of the production. And the second is the income method. In this method, we calculate all the income of the factor of production. And third one is the expenditure method. In this method, we get together all the expenditure. Actually, these three methods, these are the ways of the calculating of the national income. Output method, that is called value added method or product method. It is the method which measures the national income by estimating the contribution of each producing enterprise to the production in the domestic territory in accounting year, or in simple word, it is the final value of goods and services produced in accounting year. Order to calculate national income, these are two methods which is discussed below. One is the final output, या product method. Second is the value added method. What is the final output method? In this method, economy is divided into three sectors: primary sector, secondary sector, service sector. What is the primary sector? This sector includes the nature related activity or produce good by exploiting, example, agriculture income. Secondary method is that sector which transfer or change intermediated goods and service to final goods, example, producing sector. Service sector, this sector is known as service sector because it produces services, example is the insurance, banking, transportation, etc. Value added method. In this method, the value added to the communities in various stages of production is included in national income, whereas value added is the addition to intermediate goods in various sectors. Different stages of factors explained by the help of the following table. For example, the cotton, thread, cloth. These are the stages. In the cotton, value of output 2000, cost of intermediate multiply by, and the value added 2000. Thread 2500 and cost of intermediate 2000, value added 500. cloth 3000, cost of intermediate 2500, value added 500. And the total output 7500, total cost of intermediate 4500, and value added 3000. What is the gross value added? In this gross value added, there is a formula is equal to value of output minus cost of intermediate goods. Thus, the value 2000 ended national income. And the problem of double counting, one of the major difficulty while we calculating the national income of output method is that of double counting. The double counting occurs when the value same goods included more than one in national income. In the previous slide example 7500 is included in national income when it will involve double counting because the value of cotton is included more than one in the national income. How to avoid double counting? First of all, there are two methods with the help of which can avoid double counting, and they are discussed below. One is the final output method, second is the value added method. Final output method. In this method, to avoid double counting, the value of goods included in national income, the value of cloth 3000 is included in national income. What is the value added method? In this method, to avoid double counting, the value added in different stages of production is included in national income. In above example, the value added is equal to 3000. 2000 plus 500 plus 500 will be included in the national income. Difficulties of output method. The main difficulty in the calculation of this method are given below. Unavailability of necessary data, number 1. Number 2, problem of double counting. Number 3, problem of identifying intermediate and final goods. Number 4, problem of self-consumed goods. Income method. The second one is the income method. In this method, national income is divided in the form of four factor production. There are four factor production. One is the land, labor capital, and enterprise. And what are the reward of these four factor production? The land, the reward of land is called rent, and the reward of labor is called wages, and the reward of capital is called interest, and the reward of enterprise is called profit. This income method we also call factor method because there are the four factor of production in an economy in an accounting year. National income can be defined with the help of the following formula. NNPFC is equal to C plus operating profit plus mixed income plus NFYA. NNPFC is equal to salary and wages, supplement income, compensation in kind, retirement benefit. Mixed income is operating profit, income from property, income from enterprises, net income from abroad. These three, when we include, get together is called NNPFC. Income from property. Income from property means rent, royalty, interest. Income from enterprise is demand, corporate, undistributed profit. Difficulties of national income method. Lack of data, problem of undistributed profit, problem of dividend, allocation of mixed income. Expenditure method, this is the last method. National income can be also calculated by expenditure method. In an economy, in an accounting year, it can be defined by the following. We calculate all the expenditure and we add all the expenditure that it becomes national income. Here Y is denoted by national income, C is equal to consumption expenditure plus I is equal to the investment expenditure and G is equal to the government expenditure and X bar is equal to X minus M, export minus import. C stands for private final consumption expenditure, I stands for investment expenditure, G stands for government final consumption expenditure. Where here is the X minus M stand for export minus import is equal to the next export. Difficulties of expenditure method. Main difficulties are discussed below. Unavailability of data, problem of intermediate and final goods, problem of transfer payment. Conclusion. In the end, we can say that the study of national income is must for the study of economics, development of economy, where various methods can be used to calculate national income. Thank you very much.